In this video, we're going to be doing a basic earnings per share calculation for a company that has both common and preferred stock. This company had 820 million shares of common stock and 2 million shares of cumulative preferred stock. No changes were made during the year to the number of outstanding shares for either the common or the preferred. No dividends were paid on either the preferred or the common. Remember, preferred stock is a contractual agreement between the investor and the company. It is going to pay dividends, in this case, of 8% based on the par value of the preferred stock. So each year the preferred stock is due $8 per share, $100 times 8%. However, a company does not have to pay the preferred dividend if the board of directors chooses not to. Typically, this is done when the company needs the working capital, the cash. There are conditions in the preferred stock agreement that allows the company to forego payment. In this case, the preferred stock is cumulative, meaning that all back dividends have to be paid first before any dividends can be paid to common shareholders. For 2011, the company had net income of $426 million. And let's work in millions to make things easier. Now, the basic earnings per share formula is net income minus any dividend payments that are due the preferred shareholders. When we take net income and subtract out the preferred dividends, this gives us the amount that is available to the common shareholders. And earnings per share is that earnings available to the common shareholders divided by the number of common shares outstanding. So our first decision here is whether we have to include the preferred dividends given that they were not paid. Well, again, remember, these are cumulative. So before the common shareholders can receive any dividends, the preferred shareholders have to be paid their dividends for both 2010 and 2011. We are only going to be considering the 2011 dividends. This is the amount of net income from 2011 that is available to the common shareholders. So we are going to subtract the preferred dividend even though it has not been paid. And that preferred dividend is on 2 million shares, and we'll multiply the 2 million shares by the par value of $100 times the dividend rate of 8%. So we'll take our par value, multiply it by the dividend rate, and then multiply it by the number of shares. And again, we're working in millions. So this yields preferred dividends of 16 million. So the earnings that are available to the common shareholders is our net income divided by our preferred dividends. In this particular case, we have no changes to the number of common shares outstanding. And the problem tells us that we have 820 million shares. So our basic EPS is our earnings available to the common shareholders divided by the number of common shares preferred shares are not included in the calculation of EPS for the uh, number of shares outstanding. So this company is going to have a basic earnings per share of 50 cents. So again, in this problem, we're given information dealing with preferred stock. You have to note whether it is cumulative or not. In this case, it was cumulative. If this had not been cumulative, if this was non-cumulative stock and no dividend had been declared, then we would not make the adjustment for the preferred dividends, because a non-cumulative dividend cannot be made up, will not be made up in the future.